Let me ask you a question. If you had a friend who always repaid you on time, but then discovered he had borrowed from hundreds of others while maintaining perfect repayment records, would you keep lending to him? This is exactly the dilemma facing global investors today with U.S. Treasury bonds. With America's debt reaching a staggering $36 trillion, equivalent to 125% of its GDP, the market is now seriously questioning Washington's ability to honor its obligations. The recent downgrade of U.S. credit ratings by all three major agencies has only amplified these concerns. Hi everyone, I'm Lily, your resident Wall Street rebel with a knack for calling out the market's BS. As we speak, the U.S. Treasury is conducting an auction for $16 billion in 20-year bonds, the first major long-term debt sale since Moody's downgrade. The results, to be announced Wednesday afternoon Eastern Time, will directly impact Treasury yields and ripple through global markets. Here's what you need to understand. The 10-year Treasury yield currently stands at 4.48%, while 20-year and 30-year yields are approaching 5%. Remember this fundamental principle. Bond yields move inversely to prices. Higher yields mean lower prices, which indicates more sellers than buyers. In simple terms, rising yields signal growing market anxiety about U.S. debt. In June, there is about to expire $6.5 trillion of U.S. bonds, and the repayment mechanism of U.S. Treasury bonds mainly covers the previous arrears through borrowing new to repay the old, and it is necessary to issue more than $6.8 trillion U.S. bonds to cover this part of the mature debt. So every auction of U.S. bonds has attracted the attention of market traders and investors. If the auction situation exceeds expectations, the repayment pressure of U.S. bonds can be reduced, and if it is not as expected, it will increase the market's worries about the repayment ability of U.S. bonds. To put these numbers in perspective, America's debt-to-GDP ratio of 125% means the country owes $125 for every $125 for every 100 it produces. Compare this to China's 105% ratio, or the fact that China's 10-year bond yields are just 1.65% versus America's 4.45%. The math is brutal. America is borrowing more than others while paying significantly higher interest rates. Now let me share a perspective that might surprise you. The US dollar is essentially US debt, and US debt is the dollar. This is how the magic works. The Treasury issues bonds, which the Federal Reserve then monetizes by creating new dollars. It's a self-reinforcing cycle that has underpinned dollar hegemony since World War II. This system allows America to cash in its future earnings today. As long as buyers, whether pension funds, foreign central banks, or other nations, believe in America's long-term solvency, Washington can keep borrowing against tomorrow to spend today. This explains why tech stocks and financial markets have soared despite economic fundamentals. They're being buoyed by this endless river of debt-fueled liquidity. But this house of cards is showing dangerous cracks. Since 2022, when the Biden administration froze $300 billion of Russian reserves and weaponized the SWIFT system, global confidence in dollar neutrality has shattered. Countries suddenly realized, if they can do this to Russia, they can do it to us. The response has been swift, from accelerated gold accumulation to oil transactions in yuan. Now enter Donald Trump and his trade wars. His aggressive tariffs and sudden courtship of Middle Eastern oil states aren't just policy choices, they're desperate attempts to maintain dollar inflows. When Trump demanded $3.2 trillion from Saudi Arabia, he wasn't negotiating, he was panhandling for the world's largest debtor nation. The endgame is becoming clear. When foreign buyers finally balk at absorbing more U.S. debt, the Federal Reserve will be forced to monetize the debt directly, effectively printing money to buy its own government's bonds. The immediate effect might look deceptively positive, a temporary market high from all the cheap money flooding the system. But the long-term consequences will be catastrophic. Runaway inflation, currency devaluation, and the simultaneous collapse of stocks, bonds, and the dollar itself. History offers a sobering parallel. In 1985, Japan's economy seemed unstoppable, its corporations buying up American landmarks while its debt-fueled bubble grew. The crash that followed led to 3 lost decades. Today, U.S. debt market volatility matches levels last seen during the 2008 financial crisis. The uncomfortable truth is this: America's debt addiction has passed the point of no return. The $36 trillion debt mountain cannot be paid down, only rolled over. Each new debt ceiling increase, each desperate auction, brings us closer to the moment when the music stops. When that day comes, the Fed will face an impossible choice: let interest rates spike and crush the economy, or print unlimited dollars and destroy the currency. There will be no elegant solution, just the painful arithmetic of an empire that spent 40 years living beyond its means. The age of dollar dominance that began at Bretton Woods is ending not because of some external challenger, but because America is committing economic suicide one treasury auction at a time. When historians look back, $36 trillion in debt won't be remembered as just a number, but as the epitaph of American economic supremacy. If you're not preparing for this reality, you're not paying attention. This is Lily, bringing you uncomfortable truths about the coming dollar crisis.